Warns European Union to increase U.S. oil and gas purchases or face tariffs. Japan's core inflation rises 2.7% in November. And Switzerland and European Union reach historic trade agreement. Welcome to the Economic Bulletin, where we present comprehensive coverage and expert insights on the latest economic trends and developments. Welcome back. We start off with the United States, where consumer spending rose 0.4% in November, reflecting strong economic activity and prompting the Federal Reserve to forecast fewer interest rate cuts in 2025 than previously expected. The Commerce Department said that consumer spending, which drives over two-thirds of U.S. economic activity, increased from a revised 0.3% gain in October. The robust spending contributed to the U.S. economy's 3.1% growth rate in the third quarter, following a 3% expansion in quarter two. Economics project only a modest slowdown in spending during quarter four, with the Atlanta Fed forecasting a 3.2% GDP growth rate. The International Monetary Fund, IMF, has endorsed the U.S. Federal Reserve's recent interest rate cut, viewing it as a fitting response to ongoing economic uncertainty. IMF spokesperson Julie Kozak noted that while inflation remains slightly above expectations, it's still trending downwards towards the Fed's target. The IMF also emphasized that the disinflation process in the U.S. has been less costly in terms of job losses than initially feared, forecasting that core PCE inflation will end 2024 just below 3%, approaching the Fed's 2% target. On another note, U.S. President-elect Donald Trump has issued a warning to the European Union, demanding large-scale purchases of U.S. oil and gas to address the trade deficit or face tariffs. Trump made his stance clear in a Truth Social post, declaring that otherwise it's tariffs all the way. The U.S. recorded a $131.3 billion goods and services trade deficit with the European Union in 2022. While the European Union exports more goods to the U.S. maintains a surplus in services, exporting 396.4 billion euros to the European Union in 2023, compared to 292.4 billion euros in imports. In response, European Commission spokesperson Olive Gill has emphasized that European Union's commitment to diversifying its energy sources, including increasing imports from the U.S. Gill highlighted the strong economic ties between the European Union and the United States, expressing the bloc's readiness to collaborate with President-elect Trump to further strengthen their relationship, particularly in the energy sector. He also reaffirmed the European Union's determination to reduce dependence on Russian energy and expand its range of supply options.
A high degree of complementarity between relying down is that we are ready to discuss with President-elect Trump.
Moreover, German Chancellor Olaf Scholz has highlighted that Germany already imports 90% of its liquefied natural gas from the United States. This comment followed remarks by U.S. President-elect Donald Trump. He warned the European Union of potential tariffs if the bloc does not reduce its growing trade deficit with the U.S. by significantly increasing its oil and gas purchases from the world's largest economy.
Tariff warnings are back in focus as U.S. President-elect Donald Trump urged the European Union to address its trade deficit with the U.S. by increasing oil and gas purchases or face penalties. Trump, in a Truth Social post early Friday, highlighted the $131.3 billion goods and services trade gap, calling for immediate action. In response, European Commission spokesperson Olive Gill reaffirmed the EU's dedication to diversifying energy sources, including boosting imports from the US as part of efforts to replace Russian supplies. The US, the world's largest oil producer, is set for a record crude output in 2024, fueled by a potential deregulatory push under Trump's administration. European leaders expressed readiness to deepen energy ties, but warned against overly transactional demands. Former Italian Prime Minister Enrico Letta suggested the EU prepare for potential retaliation. The announcement follows discussions on transatlantic relations at the EU's year-end summit. Stock markets across Europe dropped while the euro gained slightly against the dollar. Trump's statement revived concerns over his protectionist stance, adding uncertainty to US-EU trade dynamics as he prepares to take office.
Joining us from Washington is economist Mr. Peter Tanius to discuss the latest developments regarding U.S. President-elect Donald Trump's warnings to impose tariffs on the European Union. Mr. Peter, thank you so much for joining us on the Economic Bulletin. First off, how serious do you think President-elect Trump is about imposing tariffs on the European Union if it doesn't increase its purchases of U.S. oil and gas?
We all know that imposing tariffs is a really bad idea. It's a bad economic plan because imposing tariffs is going to make goods and much more expensive for Americans, and it's inflationary. What Trump's advantage is that foreign leaders think he's not entirely rational. In fact, they think he's a little bit crazy. So they're concerned that even though it makes no sense to impose tariffs, he might do it anyway. So this is a really good and interesting negotiating advantage for President Trump, namely that they think he's crazy enough to do it.
Now, regarding these warnings, do you see them as purely strategic leverage to secure better trade terms, or is there a deeper agenda?
No, the agenda is simply that Trump wants to equalize trade and will threaten with tariffs or any other means at his disposal. If he were perceived as a more rational leader, like some other presidents in the past, his adversaries, the heads of these European governments, wouldn't be as worried. But as I mentioned, he's not perceived as being entirely rational. So they believe he will carry through on these threats, which enhances Trump's bargaining position. And he is, in fact, using this strategically.
Now, looking at the wider picture, what are the potential implications of these warnings on U.S.-European Union trade relations?
They'll eventually be worked out by the trade negotiator that President appoints in his administration. This means that at some point they will be required to come to an agreement on trade that works for both sides. And I expect that the massive threat of tariffs, the broad-based threat of tariffs on just about everything, will not come to pass.
Now, delving into the European Union's position, how could the European Union manage its transition away from Russian energy while balancing Trump's demands?
Well, I mean, to do what, frankly, Trump is asking them to do, and that's to diversify their sources of purchases of oil and gas. The U.S. is the largest producer of oil in the world now, and we have surpluses that are available to purchase.
And how do you evaluate the European Union's initial response to these warnings?
Meaning, well, of course, they're taking the position that we're going to have a fight. If you do this, we'll retaliate with that. But this is all part of a negotiating strategy. And this goes on for a long time and has gone on for a long time for years. As I mentioned, the big difference here is that people take Trump seriously when he makes outrageous demands because they think he is crazy enough to do them. So this is what you have to worry about. But in the end, the wiser heads will prevail, and there will be some sort of an agreement. And Trump has somewhat of an advantage in negotiating for the reasons we discussed.
Now, moving forward from your point of view, what steps can the European Union take to strengthen its negotiating position against a potentially protectionist U.S. administration?
Yes, so that is a question. Obviously, you'll have to ask them as to what their strategy would be if Trump doesn't relent. But that is not what I think is going to happen. What I think is going to happen is that we will get a resolution on trade. It will take some time. There may be some tariff impositions in the meantime, but these will be worked out. Today, the biggest problem in the United States is not tariffs. It's the fact that at the end of in a few hours from now, the government may have to shut down because Congress has not passed a debt ceiling bill. But that's what's going on here in the United States today.
Lastly, Mr. Peter, and building on what you said, could this situation escalate into a full-scale trade war, or do you think both sides will prioritize negotiation over confrontation?
Yeah, I think you basically answered the question, and that is that it will not escalate into a full-blown trade war because the cooler heads will prevail, and at some point there will be a resolution on trade. Keep in mind that this happened a bit during Trump's first administration a few years ago. And in the end, we ended up with trade deals with our various partners. And that is more likely the scenario that we'll see this time as well.
Thank you so much, Mr. Peter Qnews, for your insights and for all the information you provided us with. Now, let's move on to the latest developments from around the world. China's President Xi Jinping has called for the diversification of Macau's economy. Xi made the remarks during the inauguration of Macau's new chief executive, Sam Hufei. Sam Hufei is the first city leader born and raised in mainland China. He is also fluent in Portuguese and a former judge. Xi encouraged Macau to make bold reforms and to better play to the advantages of the one country, two systems policy. This is Xi's third trip to Macau, with his last visit occurring in 2019 during the anti-government protests in Hong Kong. Macau is focusing on diversifying its economy with a 1+4 plan through 2028. The strategy aims to expand beyond tourism into health and wellness, modern finance, high-tech, and sectors like exhibitions and culture. Kevin Hu Kinglun, director of the Industry and Commerce Association of Macau, explained that the benefits of integrating with the Greater Bay Area include boosting Macau's competitiveness, especially in finance and service industries. China's short-term sovereign bond yields dropped to levels last seen during the global financial crisis, driven by concerns over weak domestic demand and expectations of further monetary easing. The one-year bond yield fell to 0.92%, its lowest since 2009, while 10-year yields dropped to 1.74%. This decline followed the People's Bank of China's decision to keep the one-year and five-year loan prime rates unchanged, fueling speculation of further rate cuts in 2025. Japan's core inflation rose 2.7% in November, driven by higher food and fuel costs, putting pressure on the Bank of Japan to raise interest rates. The November increase marks an acceleration from October's 2.3% rise, with persistent high-rise prices and the phase-out of government utility subsidies contributing to inflationary pressures. A core inflation index, excluding fresh food and fuel, rose 2.4% in November, reflecting ongoing demand-driven price increases. Moving to Europe, Switzerland and the European Union have reached a historic deal to update their trading relationship, overcoming Swiss concerns about immigration. European Commission President Ursula von der Leyen hailed the agreement as crucial in light of geopolitical tensions. The deal, which covers areas including electricity, state aid, transport, and freedom of movement, is set for approval by both Swiss and European parliaments. However, it's likely to face a public referendum in Switzerland, where critics are organizing opposition. The President of the European Council, Antonio Costa, stated that the European Union will provide an additional 30 billion euros of financial support to Ukraine in 2025. Costa added that the European Union has already provided about 130 billion euros in financial support to Ukraine since the beginning of the war in 2022.
Targets the so-called shadow fleet. Second, we have already delivered about
Sweden has announced that it will halt funding to the UN Agency for Palestinian Refugees and redirect support to Gaza through other humanitarian organizations. This decision follows Israel's move to ban UNRWA operations from late January. Sweden plans to raise its aid to Gaza to 800 million Swedish crowns, $72.44 million in 2024, up from 451 million crowns this year. Funds will be channeled through agencies like UNICEF, WFP, and the Red Cross. British retail sales grew by just 0.2% in November, missing expectations of a 0.5% rise. Despite overcoming concerns about the government's budget, the data showed only a modest recovery. Over the 3 months to November, sales rose 0.3%, the weakest since June. The economy had contracted in September and October, partly due to tax hikes on businesses. The Bank of England projects zero growth in Q4 2024, citing persistent inflation pressures. United Kingdom long-term borrowing costs are nearing their highest levels in 26 years, with the yield on 30-year bonds climbing to 5.16% after inflation hit 2.6% in November. This marks 7 consecutive days of rising yields, the highest since 1998. Market expectations for interest rate cuts by the Bank of England have been reduced, with only 2 anticipated for next year, down from 4. Stock markets, including the FTSE 100, have been pressured, reflecting concerns over inflation and the potential impact of restrictive monetary policies. The Bank of England maintained rates at 4.75%, signaling a cautious approach to future cuts. The Russian central bank kept its key interest rate unchanged at 21%, despite expectations of a 2 percentage point increase. The decision follows recent tightening measures aimed at reducing inflation, which currently stands at 9.5%, well above the target of 4%. The central bank emphasized that the recent rate hikes have cooled credit activity and demand, creating favorable conditions for inflation to move towards the target. Inflation has been driven by military spending, wage increases, and a weakened ruble, which fell 15% against the dollar in November. The Kremlin has stated that any new G7 sanctions targeting Russia's oil industry would backfire. Kremlin spokesperson Dmitry Peskov emphasized that Russia would take steps to minimize the impact and adapt to any such measures. Peskov's comments followed a media report suggesting that the G7 was considering new sanctions on Russia's oil sector. Canada's retail sales rose 0.6% in October, slightly missing expectations. A boost in new car sales offset declines in grocery and beverage store purchases. Sales excluding automotive grew only 0.1%. Preliminary November data suggests sales were flat. Retail sales contribute nearly 40% to Canada's GDP, and economists forecast Q4 growth may fall short of the Bank of Canada's 2% expectation. European Commission President Ursula von der Leyen announced that the European Union will provide €1 billion to Egypt to support its reform agenda. In a post on the X platform, Leyen noted that the funds aim to strengthen Egypt's business environment, attract private investment, and create more job opportunities for its citizens. This initiative follows the strategic and comprehensive partnership signed in June 2024 in Cairo. Von der Leyen emphasized the European Union's commitment to fostering economic growth and stability in Egypt through this partnership. Tunisia's National Energy Observatory's monthly report on the energy situation revealed that the country's trade deficit rose by 17% year-on-year. The trade deficit reached approximately 9 billion dinars by the end of October 2024, compared to 7.7 billion dinars in the same period of 2023. The report also revealed that the coverage rate of imports by exports did not exceed 24% by the end of October 2024, with a 9% drop in energy exports and a 9% increase in imports, particularly crude oil. Oil prices fell on Friday on worries about demand growth in 2025, especially in top crude importer China, putting global oil benchmarks on track to end the week down more than 3%. Brent futures fell 0.4% to $72.56 a barrel, while U.S. West Texas Intermediate crude eased 0.5% to $69.06 a barrel. Gold prices extended gains on Friday, supported by a softer dollar and Treasury yields after U.S. economic data indicated a slowdown in inflation, although the Federal Reserve's hawkish interest rate outlook kept bullion on track for a weekly loss. Spot gold gained 0.8% to $2,614.67 per ounce. U.S. gold futures were up 1% at $2,633.20. In markets, U.S. stocks are rising Friday to trim their losses in what's said to be one of their worst weeks of the year. The S&P 500 climbed 0.7% in morning trading after erasing an initial drop. The Dow Jones Industrial Average was up 0.7%, while the Nasdaq Composite gained 0.7%. In Europe, the German DAX and France CAC 40 fell more than 1% each, while Britain's FTSE 100 posted a relatively smaller decline, down 0.7%. Tokyo's Nikkei 225 fell 0.3% after November inflation data was released. That's all for now. Here's a roundup of today's key headlines. Trump warns European Union to increase U.S. oil and gas purchases or face tariffs. The Japan's core inflation rises 2.7% in November. And Switzerland and European Union reach historic trade agreement. That's all for today's economic bulletin on Qnews. Stay connected for more news and updates, and thank you so much for watching.